Hey traders, Raghi here, and in this premium video we're going to do a deep dive into some of the daily time frames and talk a little bit about how you can schedule your week to be able to not only day trade but also look at end of day charts. And a lot of what I do is sort of bookend my week with a Monday, Friday daily time frame scan, as I was sharing in the chat room, because as many of you know, I kind of have a joke, but it's not really a joke. It's Monday and Friday hates traders. And I tend to find, after studying literally decades of my intraday trading, that my best results come Tuesday, Wednesday, and Thursday. So rather than throwing away 2 days of the trading week, I just focus on different time frames. I focus on longer term time frames. I'll take a look at stocks. I'll take a look at pullbacks and park my alerts on those daily charts. So as the market continues to rally higher, I'm just nowhere near anything on the daily time frame of the indices to be a buyer on a pullback. I will not look to buy higher highs. And you might say, well, Rog, it's been working. Look, it works until it doesn't. And this is what one of my mentors told me, and it's true. And I'm sharing it with you because it's prevented me from basically being a trader who just chases higher highs. The bottom line is this: bull markets make everybody feel like they're a whole lot smarter than they are. Or as he told me, don't confuse a bull market for brains. I remember the day he told me that. I had a great run over the course of a couple months. He said, yeah, that's great, kid, but don't confuse a bull market for brains. And I'm going to pass that same advice on to you. But the thing to remember is, when did this market, like for example, we're taking a look at the Dow. By my tools, when did this actually turn into an organized uptrend? Right there. On that day, on this candle right basically here. This was all a downtrend. Well, I should say this was all a downtrend. This is where the downtrend was transitioned into chop with a bearish bias. This is where we chopped up until that point. So this was the downtrend. This was the chop. This now became the uptrend. So the only folks who are thinking this is an uptrend, they might be using different kinds of tools, and that's fine. A pretty popular way mainstream will look at uptrends is to look at the 20 above the 50, above the 100, and then sometimes they'll throw the 200 in there too. So when you've got the moving averages structured this way, a lot of folks will say, well, the 20 crosses the 50 to the upside, and the 100 to the upside, and if the structure is basically these shorter moving averages above the longer ones, they'll say when that happens, that's an uptrend. Usually the wave and the grab candles will front run that by quite a bit. Maybe not a 20-50 cross, that might be pretty similar, but normally the wave and grab candles will front run that moving average organization. All right. So this was actually a downtrend that bounced, corrected, right? And then rather than doing this, the Federal Reserve saw to it that they inflated asset prices. That's what this is. You might think, well, why didn't we correct? Not even to make new lows. I shouldn't even make this look like we were talking about retesting the lows. Even a 50% correction. Why did that happen? It happened because the Fed decided to enact certain, and I'm not talking about the PPP. That's totally different. What I'm talking about is the Fed decided to enable the Treasury to start to buy ETFs, junk, high yield corporate. They dropped the interest rates. That's fine. They've been low for a really long time, but they injected all sorts of capital into the system. And when you look at money supply, you'll realize that money supply and the equity markets move nearly in lockstep. So once the Federal Reserve started literally printing money, as we like to say, even though they're not printing it at all, they just add some zeros to a digital representation somewhere within the Hall of Justice in the Federal Reserve. That's what happened. So I don't consider these longer term uptrends. Folks who pick bottoms probably consider this an uptrend for much longer than it was. Not I. The S&P and the Nasdaq probably took the lead on the earlier transition to an uptrend, more so than the Russell and the Dow. Tech became far stronger earlier on, and tech, of course, is so heavily weighted within the S&P and the Nasdaq that things like XLK, XLY, XLC really starting to organize into uptrends towards the end of April, beginning of May, right in here, that allowed the NASDAQ futures, that allowed the S&P futures to start looking a whole lot more bullish than their Russell and Dow cousins, if you will. So we know how we got here. We know why we're here. And now we know what we need to do. And that is, for as long as the Federal Reserve is really on a mission to pump up asset prices and keep the equity markets up, that we have to buy pullbacks. And my preference for buying pullbacks is going to echo something that I put in a premium video and a free video 4 weeks ago now. About 4 weeks ago now. And that is looking at the overall pullbacks in XLY, XLC, NASDAQ, and individual stocks that are heavily weighted in those ETFs, okay? So you might say, well, Rog, when's a pullback going to come? It's straight up, gang. Your guess is as good as mine. You know, this is what frenzy looks like. This is what hopium smoked creates. There is no downtrend. There is no correction. There's very few corrections. This market is just off to the races. And I'll just leave it at that. One thing I also need to mention really clearly, gang, is, and I had to stop this too. You'll know personally I stopped doing this about 6 weeks ago. I stopped talking about data. I stopped talking about macro because if I want to guide us properly, including myself, I need to stop talking about things that are not making any difference in the market right now. Nobody cares about macro. And there are people who will persist in pushing the macro narrative. It's not really of service to anybody right now. Yes, you might be right, but the market doesn't care. And the reason the market doesn't care is because the Federal Reserve has worked to circumvent the macro cycle. It's related to the debt cycle. It's related to the business cycle. Monetary policy has been utterly bastardized. And so now you're going to see it doesn't matter what macro is doing, because when you've got this much money in the system, again, M2 money supply, look at the Fed's balance sheet, look at the equities markets. They are in lockstep. Look at the degree to which we are adding liquidity to the system, quote unquote money printing. Look at the equity markets. Again, lockstep. So that's what they're trying to do. And I shouldn't even say trying anymore. They have successfully done it. All right. Okay. So with that being said, now, can you buy pullbacks in XLY, XLC? You know, can you further then say, well, Rog, I don't see anything on the ETFs. Certainly we don't have anything nearby on the indices. What about individual stocks? Individual stocks, I believe, have been a whole lot more realistic to hold, to buy, to get long via options mostly than the larger ETFs, because you're going to have one larger ETF, but you're going to have 6 to 12 heavily weighted stocks. So in this case, you've got one name you're waiting for a pullback on, versus in this case, you got another 11 that could pull back. Activision's pulled back previously into an uptrend. Disney has pulled back into an uptrend. Charter Communication has pulled back. So you'll have individual names. EA Sports, I talked about EA Sports just last week, is pulling back. So when you have these kinds of opportunities, meaning just simply more to potentially look at, one ETF versus 11 heavily weighted stocks, that's going to give you, let me go to the XLY here. That's going to give you just more opportunity to engage in an individual sector that's heavily weighted within these runaway indices. Dollar General was one we talked about last week. I think I threw Dollar General into the free video. All right. You guys know I've been bullish Nike since we had the reopening equities of the sports, right? We're kind of seeing sports slowly reopen, and Nike's benefiting from that. Lowe's, Home Depot. I have not been bullish McDonald's. I have not been bullish Starbucks. XLY, the number one weighted name, is Amazon. I've been extremely bullish Amazon, right? So these are the things that I want to focus on in terms of to long side. Target, a number of pullbacks. So while I have a few pullbacks on XLY, right on the way up, XLY hasn't pulled back for a while, but Target just pulled back on the 27th. The last time XLY pulled back, let me show you here, was the 14th, right? So 13 days later, I have a more recent opportunity individually in Target, heavily weighted within the XLY. XLY heavily weighted within the NASDAQ. So you might say, Rob, what does this have to do with futures trading? Everything. Because when you're futures trading indices, NASDAQ, Dow, S&P, you're day trading or trading stocks. And then the heavily weighted sectors also within those indices. So all I'm doing is I'm cracking open a futures conversation to its sort of granular element of the individual stock and focusing on the heavily weighted ones. And then I'll say, look, if I can't get into the NAS, maybe I'll take a look at XLY. And if I can't get into XLY, maybe I'll take a look at Target. Do you see? So there's a hierarchy there. There's a hierarchy we're following from this larger index to a pretty big but not as large sector to the individual stocks within each. And right now, those individual stocks, as we've talked about on and off in the chat room, those are the ones that are giving us opportunity more often. There's more of them, and they tend to be pulling back with a little bit more frequency. All right. Now, I also talked about ways we can start to get long the Dow. And the one that I liked, and I alerted this thing to you guys in terms of a conversation in the free and the premium video, was the double red on the IYT. As soon as you get two red dots, game on. You're typically going to see more strength. Well, let's go back to our initial issue. IYT hasn't even pulled back to the 8 EMA. UNP did, right? So when you start cracking these open, you ask yourself, wow, at least NSC pulled back to the 8. If nothing else, so once IYT starts moving higher, then you start asking yourself, where else can I be a buyer? LSTR is interesting to me. I'm a little concerned that it moved lower on a day that everything was moving so much higher on the broader averages, but I'll keep an eye on this, but this one could be an interesting one. LSTR for a pullback buy. I'd go with options. I'm going to jot this one down and we can talk about it tomorrow when I'm on the mic in the chat room. You might say, LSTR, Rob, what does that have to do with trading the Dow futures? IYT, right? It's kind of like knee bone connected to the leg bone. This is dem bones, gang. Dow, heavily weighted sectors, individual stocks. LSTR is like a little tiny piece of the Dow. Tiny piece of the Dow. So you look for pullbacks in individual names. So if I can't hitch a ride on IYT, I'll hitch a ride somewhere else if I can. What about something like XLI? Again, Dow's not coming back, but XLI, two red dots. Can I get a pullback buy on any one of these top 11 names? Preferably one, as we say, that is double green. And so that's the way we can, again, engage the broader averages to the upside by looking at these heavily weighted sectors. Okay? And so where else can we look? The semiconductors is an interesting one to look at alongside the Dow. Alongside the QQQ. Double green SMH. I am long and you guys are seeing a little bit of my stock trading life right now. You guys saw earlier, we had a really good run on the ETFs until we got stopped out with sort of the hopium across the globe. But we had a really good run on the country ETFs. And then I transitioned back to commodities. Commodities had a really good run. And you know what? Let me mention this here, because I think it's really important. I'm going to put this in a notepad here. I think this is super important. Okay? We had a really good run with the country ETFs. And then what happened? Transitioned out, stopped me out. Not across the board, but in a lot of them. We had to let them go. Country ETFs. Then we started looking at some of the commodities in the wake of the COVID. Think our pork and beans trade or our ag unwind, as I called it, right? Terrific until it wasn't, right? I think we were playing the chop in the indices for a while. Was great. Chop in indices was great for day trading until the bullish bias seems to have taken a hold since about mid-May, until it wasn't, right? I was able to play gold, copper, dollar and even bonds great until it wasn't. All right. So you can see what happened. We were winning. We lost our edge. Oftentimes got stopped out. After a lot of wins, we got stopped out. And then we moved on to something else. Notice I didn't say, oh, country ETF stopped me out. Let's get right back in them. That's going after the same, person who took your lunch money. I'm not going to do that. I'm going to look elsewhere. So notice how it just kept evolving. Then we just kept moving with the narrative. All right, that's done. Okay, there. Oh, that's done. Okay, here. Okay, that's done. Now what? Now what I'm telling you guys is where I'm transitioning to, and that is, can we look at the individual stocks? We've talked about this for a while in the room, but I definitely like to, now that we've got a much firmer footing, individual stocks within the sectors and indices, it's actually giving us more opportunity than the sectors and the indices, because now we're looking at one sector, one indice, and then anywhere from 11 plus stocks that we could choose and take advantage of when they pull back. All right. So again, we've adapted once again. Okay. We just have to keep moving with it. So I hope that makes sense. I hope that helps. And this is where I'm going to continue to move forward. Like, okay, what's next? Right. You're not going to see me go back very much. Places where I've lost the edge, I've lost the narrative, I've lost the trend. There are plenty of places like that. I'm moving on to where the next opportunity seems to be. And that is, all right, well, it looks like the traction to the upside is, at least for now, real. Let's stay nimble. Let's wait for those pullbacks, and let's focus on the double green uptrends. And you'll see me revisit this throughout the week, and we'll definitely talk about this again on Friday. And you can definitely do this on your own, right? Once you get the double greens and you see the market pull back to the wave, think about how you would enter any uptrend. Okay? All right, gang. Hope that helps. I'll see you in the next update.